Thank you all for joining me. Really good to have you all, and I'm looking forward to discussing better governance. One of my favourite topics, actually, and I know that I've spoken to you all individually in the past about this, so it's great to have you all. To start us all off and sort of set the scene for this panel, give us a flavour of what we're going to discuss. I'll come to each of you to introduce yourselves. I know you've been here before, Dan, but ask you to introduce yourselves and discuss what you think good governance looks like. I'll start with you, Dan.
Okay. So for me, it's really about businesses acting in the best interests of their shareholders, which ultimately is in the best interests of their other stakeholders as well. And I'm sure we'll get into that. But investment managers acting in the best interests of their clients. And I mentioned that is absolutely obvious. But I don't think it's about ticking boxes. I don't think it's about questionnaires. I think it's about the genuine behaviours, attitudes and culture of the people that are leading the business. So it's how they're allocating the business's capital, which is ultimately shareholders' capital. It's how they behave in private as well as in public. So it's I guess my approach to governance is just very old-fashioned.
Great, thank you. And Suresh, what does good governance look like for you? And yeah, please introduce yourself.
No problem. So Suresh Mistry, I'm Head of ESG and Impact Reporting at Alquity Investment Management. I'll go into a little bit more detail. I think there are 4 aspects for us when we're looking at companies and looking at putting them inside our portfolios. Because we're an ESG investor and governance is basically the foundation on which the ESG house is built. Because if you don't have that, the rest is risk and likely to fall over. So the first thing, and I used to be a banker, and one of the first things we used to do when we used to lend money to people is say, what's the character and capability of the person looking to borrow that money? And when we're looking at management teams, that's the first thing we look at. What's their character and what's their capability? Are they able to deliver what we expect them to deliver from a shareholder perspective, but from a strategy perspective? But do they also have the right character? And I can give you, because we're going to trust them with our clients' money as well as are putting them into our portfolios. So let's take an example. We're an emerging markets investor. One of the big stocks in emerging markets is Samsung. It's well known across the industry. We look at that business and it fails immediately from an ESG perspective for us because the chairman, the current de facto leader, is in prison for embezzlement and bribery charges. His father was indicted on 2 counts of the same stuff. Actually those got receded because he bribed the president at the time of Korea to let him off. Now, if that isn't enough to stop you from investing in that business, I really don't know what is. So first of all, look at the character and capability. Secondly, clearly these management teams need board support and board independence guidance because as an investor, as a shareholder, I need to ensure that the decisions are being made in the interests of the organisation. It's not just about ticking a box and saying, yeah, we have 3/4 independent directors. It's the stature of those people. Are they capable of standing up to management? It's also their attendance. Do they actually show up at audit committees and remuneration committees? Because there's one thing having them, there's another thing them actually doing anything within the business. So board, management, auditors, making sure they have good quality auditors, people who will produce those reports, produce that information that we then rely on in terms of our investment decision making. And then finally, the ultimate part of governance really is the commitments they make and the policies they implement, whether that be from an ESG perspective, whether it's equal opportunities, gender diversity, whistleblowing. There's one thing having those policies, but there's another thing them actually implementing them. So you can tick a box and say there's a whistleblowing policy, but then if you look at the amount of times the whistleblowing policy is actually being enacted and you see it's never being done, that makes you question the actual governance within that organisation. So I'd say from our perspective, absolutely what Dan says, but you then, as an investor, you have to look deeper. You have to have some standards and you have to have some criteria to go by.
Fantastic, thank you. Mandy?
Hi, I'm Mandy Kirby. I'm Chief Strategist at City Hive. I think I'm always reminded of, there used to be a Reuters newsfeed called Boring But Important. And that's kind of what I think. It's about a way of giving predictability and reassurance and taking away the big questions that you have to ask so that you can spend time on the more interesting elements of it. And also I think lifting it up from just a company to more of an industry perspective, it's also about the trust in the industry and about giving that reassurance to the broader stakeholders that I know we'll come on to later on.
Sophie, thank you.
Hi everyone, Sophie Kennedy from EQ Investors. I might disagree slightly to start with Dan in terms of, you know, if you please shareholders, the rest of the stakeholders will also follow. I think that...
So, Sophie, I would disagree with that too.
Okay.
That's not what I said. So I'm about to agree with you, I imagine.
So I think, you know, focus on all stakeholders is really important when we're talking about what good governance means. You will have heard me talk a lot about our B Corp status, the idea of moving from kind of shareholder primacy towards all stakeholders, and you know, as Mandy said, I think we'll come on to that. In terms of what we look for from a fund perspective, we invest in funds, not directly in stocks and companies. Suresh, I think you covered off most of the things that we would look for. I guess from managing a business perspective and with my chief exec hat on, when I'm sitting kind of in the boardroom, what am I looking for? Diversity, inclusive voices, and strong leadership. And I think if you can kind of drive all of those things and you've got the processes and policies in place to ensure that the structure is there, that's the boring bit, the codes and the stewardship, that you can produce a business with good governance.
Fantastic. I'm going to stay with you, Sophie. So, yeah, we've discussed what does good governance look like to all of you. We need to understand why it's important. Why is it important for companies to focus on all stakeholders, like you said? What does the good governance mean to different stakeholders, and how does it improve business resilience?
Okay, tackling the first question, the idea of why it's important. Obviously, shareholders are very important. We know that that's kind of where the capital is. So I'm not disagreeing that we should be focusing on them, but I think there's been a move, certainly if you think of the kind of existential crises that we're having at the moment, communities, ecosystems, climate change, it's really come to the fore that if we don't, as a finance group, stand up and hold ourselves to account with regards to what's happening. I think Phoebe mentioned it in the session earlier, you know, there needs to be more capital allocation towards the UN SDGs than the private markets can do. We need to help. And the whole idea of shareholder primacy over the last years has been a focus on making shareholders as much money without thinking about the non-financial implications. And everyone is waking up to the fact that now we need to look towards the latter. So it's hugely important. With regards to your second point around, and I don't want to kind of hog the stage, just quickly, I think for me, one of the most important things and one of the most important stakeholders for me is our clients. And so what's important from a governance perspective there? What should I be thinking about? Transparency, reporting is really important at EQ. We're a sustainable house. And without that reporting that goes with our investments, we could say that we're doing anything. And with impact reporting, Suresh, I'm sure you agree, with impact investing, it has to come reporting. So I would say the kind of transparency and reporting angle of governance is really important. Business resilience, I might answer that question slightly differently. If you don't have good governance, what does that do to your business resilience? It opens you up to, you know, the serious risk of fines, increased liabilities, reduced investment, reduced revenue. If some of your clients are going to go elsewhere and find other opportunities, and from a profit perspective, additional costs to kind of match those liabilities. You know, those three are kind of a recipe for disaster.
Yeah, absolutely. Suresh, did you have anything to add to that as you're coming from an emerging markets perspective as well?
Firstly, I mean, shareholder primacy is the reason we're in the hole we're in right now in terms of climate change, inequality, loss of biodiversity. It's the abuse of the planet and its resources and its people that has led to the issues today for the pursuit of profit. Let's face it. And that's been driven by the investment world who are pursuing returns. And businesses have been pushed to do exactly that. Now, we're in a state where we have to change that and clearly share wider stakeholder relevance and values are much more important and quite rightly so. Now, in this situation, business resilience is just heightened. It's not reduced, and I absolutely agree with you, Sophie. actually, let's look at the positives here. I'll give you an example. Well-known, Unilever. We all know Unilever, hugely successful business in its own right, but from a sustainability perspective, leading that charge. They came under threat for a takeover from Kraft Heinz. And what happened at the time? It was the only time in Kraft Heinz's history that they failed in a takeover, was because all the stakeholders with that support, Unilever supported its partners, its consumers, governments, etc., came out in support of the management and blocked the bid. Now that's business resilience. That's a real opportunity for us to say this is where actually looking after all your stakeholders is important. And I think for us in emerging markets, that's increasingly important, because when we see rising inequality in the developed world, it's accentuated several times in the emerging world. When we see climate change, we don't see the impacts. It's the sub-Saharan Africa, it's the global south that actually will see the impacts of the climate change we are delivering through the businesses and the focus on shareholder primacy. So I think for us as emerging markets investors, it's not only a case of supporting business, building sustainability, and by sustainability I'm talking about stakeholder primacy rather than just shareholder primacy, into business models. It's no longer a case of giving a bit of money to charity or reducing your carbon emissions. It's about saying, look at my value chain and where can I put sustainability across the whole value chain. It impacts my clients, it impacts my people, it impacts the communities, impacts the economy I'm working in. So for us, it's a critical part of how we do our work.
And I'd just partly challenge what we say on one of those things, where not most of what you said, but you just started with saying that the pursuit of profit was what got us into this mess. And I just colour that by saying that it's the pursuit of short-term profit that got us into this mess. That actually, I guess you probably agree that it's a as you talk about sustainability, what do we think of as sustainability? It's long-term, and actually, and Kraft Heinz is a perfect example. Very short-term orientated business, whereas Unilever were taking a much longer-term perspective. And so when we think about governance, it seems to me that it should force us to think long-term as investors, rather than being, as you say, shackled by the short-term, the quarterly numbers, whatever it is, and that's where we get ourselves into those problems.
Yeah, 100% agree, 100%. I think that's the point, is this quarterly number, it's this quarterly review. We need to push that away. And I think Paul Pullman tried to do that at Unilever. He said, look, I'm not going to do quarterly reviews. You'll kind of hear from me every couple of years or so, because that's how long it takes to often deliver some of these changes and deliver the returns that come on the back of them.
Mandy, as someone who's had oversight of the industry, how has the conversation changed around governance? Have you noticed any new trends?
Sorry, I'm not omnipotent.
Yes, you are.
I will take that. I've got oversight of the entire industry. I think this is a really good example of how things have changed, because that the Unilever moment, I think, was a bit of a hairy one, because we didn't know that it was going to turn out all right, and I think it would have been really crushing if that had gone through. But it's a kind of a rare but hopefully emerging example of things starting to change and move in the right direction. And there's a kind of objective element to it. So the universal owner aspect, where your asset owners realise that they might be doing themselves a disservice if they didn't think more broadly about all of the areas they're invested in. You also got a much longer, I think, really history with companies who have been literally on the coalface of some of these issues, and have been maybe trying to give some of these issues back to investors and not had a lot of traction with them in the past. And even within companies, those multinationals that had operating environments that were at higher climate risk, for example, they've known about some of these issues for decades. And we're playing a big game of catch-up to a certain extent in some parts of our industry. But we are seeing the conversations really changing, and a lot of things that a couple of decades ago, shareholder primacy being one, nobody would have questioned it, and now actually everything is on the table for discussion. And I heard a lot today about collaboration and the need for people to work together, and I think there's this sense that no one has completely the set of answers, and people need to move from the kind of emotional targets that we've had around things like net zero in 2050, which is not something that people can really hold in their hands at the moment. We heard that we need to have a bit more of a concrete target or set of targets to move towards, and we're starting to have better conversations now about what concrete examples of what investors can do. And right now we're in the phase of everybody collaborating because we don't know for sure. And I think you'll know that when you've got traction, when people start going, okay, we're not going to play with you anymore, we're going to go and do our own thing.
That's really interesting. Sophie, how do you break down governance when you're questioning companies or asset managers to invest in? Are there any specific governance standards that you use or metrics?
Not specifically on the fund research side. I would probably, if I'm thinking about kind of governance metrics, I would probably talk to our B Corporation status as a business and what that really means. It's a stamp of verification that our performance at social and environmental levels is of the highest quality that it needs to be. If I was an investor looking into businesses like myself, it's exactly the kind of verification that I would be looking for. It's a really stringent process, and it's not a kind of you get certified and that's it. It's an ongoing process. You have a recertification every 3 years. It's very in-depth. It covers every stakeholder. And it really looks at what you're trying to achieve, the additionality, and it pushes you kind of year on year to improve what you're doing. So I think it's not, it's not a law, it's not enforced, but it certainly adds that level of accountability that I think that we all need in the finance industry.
Definitely, yeah. And Dan, are there any specific questions that you're asking in your conversations when you're questioning around governance or any particular standards?
Yeah, and I think there's a couple of things to say here. I mean, we're blessed with having an enormous number of analysts around the world who are meeting with fund managers and gauging their ESG commitment. And I think we're looking for fund managers that when they do have ESG products, for example, that they're taking it really seriously and doing it properly as you'd expect from us. But then I think it's also a question of looking a bit beyond that as well, where you might look at the ESG commitment of an entire business, but then what about the underlying fund itself? And then, as was mentioned in the previous fireside chat, looking at the underlying holdings. You know, what is actually in the portfolio? And it seems to me that so much has been launched, so much product has been launched over the last few years. We've got to be really careful, not just with what's said by the portfolio managers, but also what's then reflected in the portfolios. And so you need the data clearly to do that. So I think it's that combination of asking the right questions, which obviously cover an enormous number of areas around ESG, but then verifying that with the underlying holdings and the data.
Yeah, that's so important, isn't it? And Mandy, I know that through your work at City Hive that fund selection teams are embedding governance into their research, and you've looked into that quite a bit, haven't you?
Yeah, so we created a framework that we thought could help with that process of sharing information. I come from a background of a lot around corporate and investor disclosure, and I know that no one really likes to do a lot of reporting, but having a framework for an investment company to be able to disclose around what they're doing so they can demonstrate a clear line in terms of their outward commitments on investment and how they're living those values internally was really important to us. So we've tried to create something that will work not just for the people who are asking the questions, but for the company as well, so they can a bit like the B Corp, be able to see the position they're in and also the ambition that they've got to be able to progress, and that runs across all of their kind of aspects of culture.
Fantastic.
I think, if I can just broaden that out a little bit, I think this is exactly what the industry has needed. Talking as a kind of fund selector and managing a fund selection team, having something that's kind of standardised across fund selectors is really important. I think if you look at ESG, one of the criticisms will be that nothing is standard. Everyone relies on, or not everyone, but a lot of people rely on data. You touched on kind of the data side of things. You have to really understand how that data has been put together to use it properly, and each data provider will have very different methodologies. So having some kind of standard approach that isn't data heavy, that really brings out that qualitative side of things, is exactly what we need. We've been doing it at EQ to a lot lesser extent only internally, to be able to really understand when a fund when a fund manager says that they integrate G into their risk mitigation or their opportunities, what that really means. So yeah, all for it.
Yeah, I think just building on that, as EM investors, we've been doing this for the last 10 years, and you make mistakes on that journey as you're going to learn about ESG investing. When we started, we knew it was a great idea, and we knew it's the way we wanted to go, but how do we actually implement it in practice? And over the years, you learn through that. You can't switch it on like a tap. It doesn't work like that, and particularly in markets which are kind of often opaque, such as emerging markets. You have to have standards, you have to have frameworks and structures. And what we've found over the years is by developing, for example, we have red flags right at the beginning of our process, at our filtering stage, where we just say, no, if it's a high energy use company and they don't produce greenhouse gas data, we just don't go any further. It's that kind of base level that you need to set. Because actually, if you ignore that at the base level, you then further on down the line.
Do you have a process for telling them that you're not going to do that then?
Yeah,
so you're communicating.
Part of our communication. Then when we're actually voting, the other kind of other extreme of, one, actually not investing to start with, and then B, when you're actually investing, having some principles in your voting practice and working with people like ISS to say, actually, look, we want to target a 50% diversity on the board. And if there's a 100% male board and they want to go for re-election, we'll vote against them all because it's not achieving our goals. So having those standards and having a framework that your investment team, and the issues are often, there's a lot of subjectivity here when assessing a company and a sector and a country and understanding the context. But if you can give your team and work with your team to get those base standards, those kind of values that are universal rather than country or economy centric, then you can achieve that standardization, you can achieve and communicate that to your clients and your investors so they're confident that actually what you're doing is absolutely what it says on the tin.
Yeah, some really interesting points there. And I want to sort of move on that discussion, and we've talked a bit about the fund industry, but let's go down that route. We run a campaign for better governance across all the titles at Bonhill. We recently run a video series called Best Behaviour with the B Corp investment groups around better governance, and it's asking investment firms to really look inwardly and question whether the values they have internally are what they're expecting of the companies are there with what the companies they're investing in. So how important is that to you when you're all looking at portfolios or how you're measuring different companies? How important is the culture of an asset management firm, and in an industry where we have faced some huge problems around corporate culture maybe and some instilled behaviours as well? Dan, I'll come to you first. Sorry, that's such a long-winded question.
No, it's a great question. So I'd argue culture is everything. It's absolutely everything. It's how people behave when nobody's looking. But it's a really tough thing to get under the surface of. And frankly, one of the challenges of having fewer opportunities to get together as an industry than we had pre-COVID and even a decade ago is that you actually have fewer offhand conversations with different people in the industry. There's less opportunity to actually build up that idea of what the culture is really like inside a business. And but culture is so important, and it can't be seen just in a snapshot. You have to see how a business evolves over time, and who are the people that they're bringing in, who are the people that are leaving. And culture isn't static either. Culture changes over time. But I think it's for me, it's the most important thing, because what we are tasked with doing is looking after people's futures. And it takes actually a very special culture to put the needs of that end investor before their own as investment managers. And you find it, and it's magnificent when you find it. Sometimes it doesn't stay, but it makes a huge difference to the outcome for that end investor. So it has to be, I think, such an important focus of any fund research operation.
And yeah, Sophie, same to you. How difficult it is to measure? Is it to measure corporate culture within asset management firms when you're sort of considering where to invest?
Very difficult, and it's something that we spend a lot of time on. So whenever we're conducting kind of the fund research or the fund due diligence, the asset manager is just as important to us. We don't look at the fund in silos. I guess potentially what I would add is something around the intentionality of that asset manager. I think in a lot of circumstances, if you use ESG as an example, even traditional mainstream investors now integrate ESG. So trying to kind of distill the wheat from the chaff, I guess, one of the things that we will look at is really what is the intention of the asset manager? What are they trying to achieve? And it kind of comes out in their culture, I think. The kind of things that we would look at that I could talk to are their voting policies. You've mentioned that. I think that we've improved the reporting around that. There's a lot of work being done with the likes of Tomello at the moment. And to be able, it's all about kind of transparency and reporting. And if you can see the data, you've got something to go on. So the voting policies, the stewardship policies that they have, they are, in essence, the stewards of capital for our clients. We want to be proud that they're doing what we would do if we were the direct holders of those companies. So what are their responsible investment policies? And a broader one that you can't really kind of get away from is what collaboration are they doing? What initiatives are they working for? Because that really shows their intention. If they're doing it from a financial material perspective, that's one thing. But if they're collaborating with the industry on initiatives, whether that's deforestation, healthy eating, share action is a perfect example of that, then you can really get a feel of what their identity is. And that's kind of a qualitative assessment that we spend a lot of time on.
Yeah, Mandy, you obviously mentioned with the ARC framework, you're trying to help investment firms measure an element of corporate culture with that. What are they finding the most challenging?
I think there's a lot of disclosure requirements at the moment. So it's really about how do you distill something down into a meaningful disclosure and that can then be used, and how an end user can then look at it and go, yes, this actually makes sense to me and I understand it in the context it's been given. Those things I think we need to allow an iteration. We need to allow people to be able to make mistakes a little bit and try things out and see what works. And I think there's a lot of concern from many companies about being open about this stuff and then being challenged on it and going, why aren't you doing this well enough? Why haven't you got better data on this? And so maybe we need a bit more of a focus on actually the process and some of the milestones that will get us towards the targets where we see data changing. So we wanted to do a lot to help companies to be able to talk a bit more about some of the good things that they might be doing internally that they don't recognise as really important. So, it is more qualitative, but it is things like, we've got a process in place to improve on this. And when you talk about things like initiatives, it's really great to see those things, but we have moved, I think, in the last couple of years from seeing loads of initiatives being put on the table for people to sign up to and, put their name on a website and whatever. But what we'd like to see now is there being some sort of evaluation of why this is important to us and how it got put on the table in the first place and who gets to propose the initiatives that we support and why does that relate back to our values as a business, and to get a bit more structure around it. And we're not, there's almost nobody that has got a good track record on that at the moment, but that's where we want to get people to actually sort of, corralling it a little bit more.
Suresh, so what would you say needs to change for the asset management industry's culture or behaviour to change? What needs to happen? Are there any solutions to this?
I mean, I think what reflects the culture of the asset management industry is a simple number. The industry makes a 35% net profit margin, which means the pressure to change is just not there, really. You know, you look at the issues we've had with the ESG greenwashing, for example. It's because, and when we analyse it from our perspective, it's because, firstly, there are existing mindsets within the industry that if you've never used ESG, you've been a fund manager for 20, 30 years, you've never used ESG, all of a sudden people are telling you to use ESG, and you're saying, well, I've been doing my job for so long, never needed it, what's the use of it? And so companies who are desperate to kind of join the ESG bandwagon are saying, actually, what we need to do is have an ESG team, and we'll have a separate ESG team to the fund manager, and the fund manager still kind of, you know, takes the data and then ignores it and continues to do what they want. So as a consequence, you get this greenwashing issue of funds having a label that does not reflect actually what's in the portfolio. And at the same time, the industry has, and this is where the initiatives are really kind of frustrating from our perspective, where you'd have an initiative to say, you know, the target is net zero, and you'll have lots of companies signing up, and you look at the percentage of assets committed to net zero, and it's 20%. So you're kind of going, okay, 20%, but you know, we've got to change. Climate change is happening now. We've got 10 years to deal with this problem. It shouldn't be 20%, it should be 100%. Well, why is it 20%? Because that 80% exists and makes a lot of money. And so the actual commitment, where is the courage in the industry to actually turn around and say, actually that mandate, I'm not prepared morally, I'm not prepared to run that mandate any longer. Because it does not fit in with my values. Because if you're espousing ESG, diversity, or whatever the values are, but you're still investing in the old traditional funds or whatever it may be. Now that takes courage, and it means you have to think about long-term profitability, not short-term profitability. And I think this is where the industry has a challenge right now, because if we were an industry making 1 or 2% and the shift of ESG or the margin compression or whatever was actually going to take us into unprofitability, then I think we'd move a lot quicker. We'd make these decisions a lot sooner. And so for us at Alquity, when we set the business up, we kind of looked at this number and thought, what can we do? And I think it's about allocating our own capital to change the culture of the industry. Don't create new products, create new businesses. Change the business model. Think about, can I actually donate, use my own capital to shape the society as I want it? And Dan and I were talking earlier about, you know, the fact that social mobility is a real challenge for this industry, in the sense of most of us have come from good universities or good degrees or good households. How can we actually put our money towards helping those who are in, you know, in less fortunate environments to actually access the industry, to change the thinking, bring people from other industries in? So I think culture change requires some really quite courageous moves in the industry.
I'd just add to that, though, just that point about people saying, well, I don't want to invest in these companies anymore, and that's when it comes back to governance, isn't it? Because there's a real choice that we have of either disinvesting and potentially putting supernormal short-term but supernormal returns in the hands of people who don't care, as opposed to actually exercising our governance muscles and engagement muscles and continuing to own these businesses, but being really good as stewards of our clients' capital and acting in governance there. So I think that's when the debate possibly gets a bit more nuanced with some of these.
Yeah, Mandy, what Suresh was saying would be quite a radical change for the industry to embrace. Do you think that that's somewhere we would ever get to?
I don't see why not. I mean, so you mentioned social mobility. It would be remiss of me not to say that I'm on the task force which is looking at social mobility for professional services, including the investment industry, and they just launched a new membership body which will have a lot of resources and a lot of collaboration in terms of trying to address those types of issues. And that's one point, but obviously that's the focus of that body has been on senior leadership, and you want to get the pipeline coming in and you want to get the conditions right, and also you're tackling things like, well, if you make it into senior leadership, what you've kind of essentially changed your shape to fit the structure that's there. It's not necessarily that you as your authentic self. There's been, you know, so there's lots of challenges there. But I think that, you know, we talked earlier about how the norms really have shifted in a lot of ways, and so I don't see why we can't do the same thing here. we went through a pandemic where we all had to work from home, and that type of accessibility in the working environment were things that people, marginalised people have been asking for years, and they have been denied. But somehow we found it in ourselves when it affected the right group of people, to be able to bring a massive change in the way that we worked. So we know we can do it. We just need to work out what the levers are. How do we make it difficult enough for the right group of people? And I think that the start of it is always by asking the right questions, asking challenging questions, and keeping on with those conversations.
Sophie, is there anything you wanted to add to that one before you ask the final question for all the panellists?
Not really. I guess from a positive perspective, I think there is a lot of good stuff happening. It's probably not happened as quickly as it needed to, or as broad brush as it needs to be. But I think with the education that's happening, and there's a huge amount of education, I think that, as Mandy said, there's no reason why we can't get to where we want to get to.
Yeah, absolutely. Okay, the one final question, which has been a bit of a theme for some of the panels today, is what action point or key takeaway would you say to the audience to go away and maybe share with their business or their colleagues? Dan, I'll start with you.
Yeah, so I know this is a governance panel, but I just want to pick up on Suresh's point and Mandy's point as well, because I think this is so important.
Okay.
We were talking about this earlier, that we just never see people at that entry level in our businesses who haven't typically got a master's. Someone's paid for that. Gone to a good university. Possibly to get to a good university, went to a really good school. They may not have paid for it, but they were sat in a catchment area that allowed them to go to a really good school. And so we just don't have people from really tough backgrounds kind of coming through, and that's, I just feel passionately we just have to change.
Yeah.
And so what I'd leave with, people come up with better comments on governance, but what I'd leave with is we need to get into the schools and actually find these people, who we can bring through. And it's not comfortable, and it's not easy, and it requires time and money. And it's still not going to solve a lack of diversity at the senior leadership level. It'll take a long time to do that. But I think if we can focus on that, I think that could be really powerful. So I appreciate that that's not on governance, but as it came up,
it makes sense. We've got the investment 2020 in the industry, but maybe there needs to be broader.
But even things like Investor 2020, which is brilliant. We work with them, a fantastic organisation. But I think sometimes you've got to have someone that provides access to something like that. People have to know it's available.
Yeah, exactly.
And that's why you have to go even deeper into schools.
Fantastic, thanks. Suresh, what's your one takeaway?
It's a quote I read earlier. It's basically, the quote says, everyone thinks of changing the world, no one thinks of changing themselves. And I think the really important thing we need to take away from here is what we can do to change, to make things happen. And for us, it's, we've always believed, or I always believe, the way you allocate your capital shapes society. And to Dan's point, as an industry, if we want to see that social mobility, we want to see the funds being offered, or the diversity, we should put our money to it. We should actually just wait for somebody else to do it. So, if we all have to collaborate to actually divert our own capital, let's face it, we've got a lot of it, we're making some good margins, so let's do that. So think about changing ourselves, not create new products, change our business, and that will actually change a lot very quickly.
Very interesting. Mandy?
Obviously, go and have a look for the ACT framework, and that'll give a lot of the answers to those questions. Would be my one takeaway. But I think that building what you both have said is that there's a couple of things that you can do really easily on your phone. Is for one of the things about social mobility for me is people who don't need the help don't ask people if they can help them, maybe. So you could, one thing you could do is go away, and if you see someone that might benefit from help, ask them if they want help, offer it out, because people that come from less privileged backgrounds don't tend to know to ask for things that they don't have. So that's a very practical thing that you can do. And the other thing, we talked a little bit in the pre-panel bit about unconscious bias and the way that we challenge our bias. One of the things that's really missing from a lot of conversations is looking for the biases we have, looking for our blind spots, and we're not going to change things, we're not going to improve things unless we actually try and find out what the blind spots are. And bringing new voices into the conversation is one way of helping that, and that is really how we're going to end up changing the world. But also look at that framework.
Thank you, Sophie. Not to put the pressure on you, we're running out of time. But what's your takeaway, please?
Very quickly, one of the kind of key drivers of governance, I guess, for your businesses will be your constitutional documents or your articles of association. I would say go and have a look at them. If they're solely focused on shareholders, pressure your CFOs, your CEOs, your boards to maybe think about broadening that out. B Corp is one way of doing it. Just changing your articles of association to focus more on purpose and people is another. And part of the series that you're doing, Natalie, is all about kind of bringing this to the fore and offering ourselves, I guess, as CEOs to work with your CEOs or yourselves to make it happen.
So that takeaway was go to ESG Clarity more. Okay, thank you all for that panel. It was absolutely great. We could talk about it for a lot longer, but that brings the end to the summit.